record a session recently. This is a new session that I talk about the swing trade market psychology. There's certain type of behavior that we tend to observe in a kind of swing trade scenario, and perhaps later we're gonna do a little bit more in-depth dive on the psychology of the day trade. Okay. Right, so purpose of this session is to really understand the psychology aspect of the market. This may help you identify the right opportunity when it comes to buying at the correct opportunities or sell at the right opportunity. Swing trade psychology. All right, we have to understand that the overall market psychology refers to a collective behavior of market participants. In such case that in a swing trade scenario, the psychology of participant, like I mentioned, is to help us to find that optimal entry and exit point. Recognizing the overall market participant behavior, such as short squeeze and long squeeze, can improve our trading outcome. All right, so first of all, if you don't already know what swing trade is, swing trade tend to be a situation where people wanted to hold their position for several days and weeks to profit from the price movement. And keep in mind, right, whether it's a market maker or market participant, short sellers, or just even day traders or whatnot, everybody is, I wouldn't say vulnerable per se, but everybody is subject to this type of trading behaviors. I previously did a similar session at OC Traders, but the recording was too much background noise, so I decided to record this again. A short squeeze, if you don't already know what that is, a short squeeze tend to be people who had a short position on an asset forced to buy back as the price increase, thus driving the price even higher due to the due to the need to basically stop loss on a short position. This happened often at the resistance level, and people is in fear of this the market going higher, thus creating a bigger loss in the position, creating a rapid increase in the price when the short seller is covering the positions. Inversely, we call a long squeeze, where the people who are buying positions, long traders, starting the position, which tend to be called a stop loss. As the price drop below the stop loss, it trigger the selling orders hitting at the support level, and that tend to be where people are starting to have stop loss. Now, sometimes the biggest problem is gap down and gap up situation, where gap up situation, people are forced to sell their buy back the order as a short seller. Gap down situation, where people are forced to automatically trigger all the sell positions for because of the long squeeze situation. So in a long squeeze situation, kind of inverse of a short squeeze situation, where it accelerates the selling pressure, causing a rapid decrease in the asset price. Next, on market behavior. The psychology of market participants tend to lead to a very predictable market behavior at the key price level, right? So, like we mentioned before, at the resistance, people wanted expect to see more of a short squeeze, and at support, people expecting more of a long squeeze. Traders tend to be short at resistance, and when resistance break, it triggers short squeeze. Similarly, Inversely, they long at support with the stop loss at the support, and when support is broken, then it triggers a long squeeze. Understand that this type of behavior helps swing traders to identify the opportunity to profit from the market move. And when I say, to take advantage of this behavior, is that essentially you're doing inverse of what the market the rest of market participant doing, right? You try to short after they had a good short squeeze, and try to long after there's a good long squeeze situation. And quantitatively speaking, both can be identified through math algorithms, but I'll point out later. I show some examples. What's the support, right? If you don't already know what the support is where the price level where buying interest is strong, right? So the point is that a lot of people would anticipate like this type of support whenever there's a bounce. Oh, that's a support. Oh, let me buy here and expect the market price to go higher, but instead it drop off the support. Oh, it's going to bounce higher. Let me see. It's a typical situation like this. It's a double bottom, right? Double bottom, go to higher, then broke support, then go much, much lower, right? The reason why it's much, much lower is because there's double accumulation of positions. People accumulate over here, and that's why it's create a much significant long squeeze situation over here. Resistance obviously is people when in the market when the selling interest is strong. It's the situation is that when people start dumping the stock, it create resistance. However, resistance can be broken, right, to go higher. And as to why it's broken through, or why does it break through the resistance, or why does it break through support, it tend to be more or less of a market manipulation. But that's whether you believe it or not, that's a situation we've seen. Okay, so this tend to be a price point where the people set up a short position and stop loss, right? So if people set up a short position here, it broke through, go to the next level, it broke through, goes to the next level, then it keep on getting short squeeze out until there is no more people that they can short squeeze from, right? Because when there's no more short sellers, then where's the buying momentum in the market? Right. Inversely, so that's kind of a market behavior at the support and resistance price point. That's where the key behavior I want you to observe. So in the upswing stage, so we try to categorize people's behavior into certain different stages in an upswing and downswing, right? So upswing stage typically involve with smart money accumulating, right? And later on create a breakout through the resistance that creates short squeeze, then chased by the rest of the market. Eventually, smart money exit at the price peak, leading to a stage where the market lacks interest in pushing the price higher. So the key thing is, does all the short squeeze would create ultimately a downtrend? Not necessarily, but a short squeeze tend to be a good place where the majority of the smart money can find their way out of their long positions. So what I'm trying to express is try to be a smarter traders by identify this type of market behaviors. Accumulation, breakout, market chasing, and end up with smart money start to exiting. And the last part is somewhat difficult for most of people, is to identify the exhaustion, right? So to a certain point, think about it, right? Short seller buying because they had short position, then the rest of the market comes in. But when there is no more buyers, all market lead to exhaustions, right? When there is no more buying interest and when it's exhausted, then it's not able to push the price higher, lead to final reversal and downtrend. And this example I'm giving to the right is actually FXI. And this is a situation that we've seen right before it retraced about 15%. We identified this exit from the smart money. And that's where it started to tumble. Keep in mind, this is pretty real time, right? This is real time to the respect that that it's, I think because I did this like the weekend before they did the high, but we can see the smart money started to exit already. Anyway, downswing stage. The downswing stage is inverse of the upswing stage a bit, right? And keep in mind, like the upswing and downswing, they don't coincide with each other, right? You don't go from say, hey, I'm on upswing stage, then when I finish, I'm now in the downswing stage. Two doesn't really coincide. Right, we try to start looking at identification of a downstage by looking at smart money and start exiting the position. We start to see buyer exhaustions. There's no smart money supporting the uptrend. There is no buyers in the market supporting the uptrend. The short sellers already exhausted, not able to create further downtrend. Right, so to a certain extent, right, the short sellers already short squeezed out, right? So after all that, there's no more buyers, right? So buyer exhaustion is kind of the key thing. Started to happen with the long squeeze, and the reason why long squeeze started happening is because that people. Yeah, so long squeeze, this particular long squeeze we talk about is the long squeeze near the top of the resistance, near but not at, right? We see that the people expecting support rebound did not happen. All the support buyers getting stop loss out, and that's creating a long squeeze. This type of situation, we tend to see increasing kind of a higher price support, getting very, very close to the resistance, and once the support broken, that's where the long squeeze start happening. The market structure shift, this is kind of the key. So where we started to see lower low, right, lower low on the support, and a low high on the resistance. When you have a market shift like this, it creates much further downtrend, to the point that when we see seller exhaustions, right, and decreasing sell volume due to seller exhaustion, price lower, smaller low and low, and the trading range become narrower, signaling the end of the downtrend. Potential downtrend. Right. Keep in mind, end of the downtrend is different than the beginning of the uptrend. Remember, the uptrend started with smart money accumulation. Just because it has a smaller low and low doesn't mean that it's going up. It could go sideways for a while, for a long time, until the smart money come back in and to start buying. Right. So here are the two typical potential signals that you can see a lot of places. One is called tracking oscillator, and the other one is called RSI divergence. the start of upswing, like we mentioned before, the start of upswing does not coincide with the end of the downswing, and vice versa. However, there are few tools for swing trader to identify a potential in the market dynamic changes. Right? A checking oscillator, which highlight the volume surge, which may potentially signal buying or selling pressure, and beginning of an uptrend or downtrend. And it could be at the end of the uptrend or downtrend too, but you kind of have to be the traditional signal is just limited. It's not saying it's not able to be used, but just saying it's very, very limited. There's a lot of noises, and but it's a good reference point for you to at least take a look at it. Okay, so anyway, checking oscillator identify the volume spikes to signal potential buying or selling pressure. If it's a buying pressure at the low, then it could potentially be reversing up. If it's selling pressure at the top, then it could be signaling going down, right? RSI divergence helps you to detect exhaustion situation, because exhaustion in the price movement, meaning that the quote unquote momentum is slowing down, right? So that's why you have kind of a divergence situation. Like I mentioned before, this type of signal has too much noises, doesn't paint the full picture of the market swing. Thus, at AlgoClub, we create more signal to help us identify what is the smart money doing. Can we see a better picture of the short squeeze, long squeeze? Can we identify the trend faster? And can we correctly identify a volume surge situation? The principle of the AlgoClub signal is, again, we believe that all the buyers in the market behave the same way, meaning that people on the initial upswing trend will want to have maximum buy volume, right? And because they expect the price to go up. This is a market behavior, right? At the beginning of downtrend, people expect a maximum sell volume and the price goes down, right? So that is quote unquote a typical expected market behavior situation for happening. The reality of thing is that this type of behavior may repeat multiple times, a little bit multiple time on the bottom and multiple on top, but you'll see. So here is the example of the AlgoClub signal, right? From swing trade perspective, what we can see is, for example, you can see that there's a buy volume surge here. So people already started to anticipate an uptrend, but it broke perhaps through support to a low support. Go back up again, go back down. This time you see a big spike of volume surge, which later on lead to a much bigger uptrend. And similarly, when the market is at a particular resistance, expect the trend to go down, you see a selling volume surge headed to next level of the support, right? Then market continue to go up afterward. So this type of behavior you can see easily based on where the volume surge is at, based on where the near resistance or support, and to understand if market is continuing to chasing the uptrend like this, or if it's start dumping near the top, clear support, people buying, people start dumping again in fear of it going down. We see a short squeeze over here, which means the short seller finished buying the covering the positions, but that create automatic kind of price exhaustions and start going down. Now you might ask, can you detect all this with RSI divergence or tracking oscillator? The reality is no, unfortunately. And that's why I create a signal to help me identify better what the situation of the market is. So typically I'd be able to teach the student to use the blue and white dot on the volume chart, and this is kind of spatial volume. This is not just the volume that you guys see day-to-day level. This is kind of a derivative of the volume data. Help me understand if there's a buy volume surge or a sell volume surge. So you can see it mapped pretty precisely to the top, rebound, failing, break support, goes down, create a long squeeze, buy volume coming again, add resistance, sell, 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 boom, 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 come down to the next support, then go back up. Now we add the resistance. Okay, so that's pretty easy to follow from my perspective. Hopefully it's the same for everybody else. All right. Next, we're talking about the option trade strategy. Right? The point of looking at swing trade is that you may also profit from swing trade based on certain option trade. For example, selling in a money call if you want to protect your asset holding. But keep in mind, when you have a buy exhaustions, it can and where the smart money exit, this could be a pretty significant downtrend, right? So it's not just. And nowadays, I observe the market tend to hit the support within a day and a half, literally. So it's like it go all the way down to support. That this give no hesitations and become which is good. So if you're selling, for example, if you're selling the in the money, if you're selling the in the money call, right? You say you're here, you're selling over here because of prior support. Then and the reason why we have this was because this one was due to the whole Japanese yen situation. So this kind of abnormal break of support, but in any case, that was detected before situation is happening. In that case, so this is where the next support is, and it went back up to the resistance higher. But just keep in mind, right, when you have a situation that buyers option with this money exit, you could actually sell a very short term in the money call. And the reason why it's short term, like we mentioned, is that the market now they tend to retrace back in a very short time frame. It gives no hesitation. It just went down. And the other thing is that if you see that smart money accumulation, but you don't know how long it's going to start doing an uptrend. So while you're doing a bottom consolidation, it makes more sense to do sell in the money put, right? It's, the reason for you to sell in the money put is because you have no way of expecting how long the consolidation is going to take before it goes up, right? And doing the selling in the money put allows you to essentially take the profit early from the option trade, right? Now, when do you start doing auto money calls? Now, realistically, when you do auto money call, it's very, 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 very rare, right? So, essentially, what you do is you have to identify a market structure shift, which means you have to see a higher low support and smart money accumulation, and it's about to break through resistance. That is the right point to start doing auto money call, because otherwise you're seeing delays. You could do a long-term auto-money call, short-term long-money call. It's really up to you. But to a certain point, when you get down to the next resistance, you still needed to take profit. Right, buying protected put, meaning that you started to see, which means you're long on put, out of money put, and again, this is not the best way if you're a long buyer, and typically when you long put, overall, I wouldn't say for individual stock it may vary, right? But for the index, typically you had to watch what's going on with the VX futures. So when VX future is actually broke through resistance, that is a great opportunity to buy put, because that thing just goes shoot up really quickly. Again, keep in mind, right, nowadays you see the market tend to do this 1-2 day retrace. It doesn't mean it hit the bottom, but it go down to the next level of support really quickly, right? So if you buying put, you could take profit right after it broke through support, and boom, it's like I was saying, this you basically buying put at the long squeeze situation to maximize the profit for a very short period of time. And for buying out of money call and out of money put, you really don't hold it for a very long time, unless you later on create a spread. Creating a spread situation. But we can talk about options break another time. All right, so a couple minutes of advertisement. This is why I stream every day on the Discord. Help us to identify some of the large option activities from option wealth section, looking at what the market is looking at from a gross company ticker perspective, and see if there's any particular uptrend ticker which market is chasing at the moment. This helped me identify the buy side opportunity on a call and put situation. Okay, if you want to join our community, feel free to sign up at the Discord, and this allows you to gain access to the streaming site, streaming channel, and obviously you probably see the YouTube. Don't forget to follow us, like us, give me some comments, and let me know what you think. All right, and the purpose of this video is really to help identify the market behaviors that can help you to be a better trader, a smarter trader in a swing trade situation. All right, have